Why does a conflict in the Middle East affect your mortgage rate right here in the United States? Great question. And the answer is a combination of oil, inflation, and a little bit of Wall Street panic. Real estate should make you laugh, not cry, because the right plan protects the outcome. I'm Nathan Guttman, and let's break this down. When tensions rise around Iran, the first thing global markets watch is oil. A massive portion of the world's oil supply moves through the Strait of Hormuz. So whenever traders worry about conflict in that region, oil prices tend to rise, and higher oil prices usually push inflation higher. That matters because inflation is one of the biggest drivers of interest rates. When investors expect inflation, they demand higher yields from bonds, and mortgage rates tend to follow the yield on the 10-year U.S. Treasury. So higher inflation expectations can push mortgage rates higher. But here's where things get a little bit interesting. When global uncertainty rises, investors all over the world often move money into U.S. Treasury bonds. Why? Because they're still, hopefully, considered one of the safest investments in the world. When demand for bonds rise, bond yields fall. And when bond yields fall, mortgage rates can usually drop. So global conflict can create two opposite forces. Oil prices pushing rates higher and global fear pushing rates lower. Which one wins usually depends on how long the situation lasts. If energy prices stay elevated, inflation pressure can push mortgage rates up. If markets are simply reacting to uncertainty, we sometimes see temporary rate declines. So yes, a conflict thousands of miles away can absolutely affect the cost of borrowing here at home. Global economics touches local real estate. And real estate should make you laugh, not cry. If you want to know what all this means to you, or if you're evaluating your real estate options, let's put a structured plan in place that protects your position, because clarity compounds results.